Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. 2 weeks ago, I said that there were three major patterns developing here in this market in recent times. Firstly, there was the possible early February to date bearish halfway hesitation. This has a potential target in the 192 even area. The next pattern was indicative of the then bearish state of the market and gave the bearish angle of attack at the time of this market. It was a mid-February to mid-April bearish Andrews pitchfork. The third pattern was still in construction. It is the mid-November 2021 to date head and shoulders top with a neckline acting as a backup support last week. The neckline, currently at 199 3/4, is the nearest to the current market and indicated that this proposed head and shoulders top was almost done in its construction. So what could we expect? I said at the time, and I quote, "Well, it very much depends if prices can drop down through the November 2014 high at 201.35. Because then we can look at additional possibilities on the downside and not just target X below." And that's the end of the quote. The top side at the time was capped by the flat long moving average, currently at 219.60, plus the 50% Fibonacci line of the August 2021 to February 2022 move at 217.45. I added as a final note, and I quote, that should prices punch up and maintain levels over these, then the bearish halfway hesitation as well as the head and shoulders top and even the bearish Andrews pitchfork will all cease to be the primary drivers of this market and something else will have to take its place. End of quote. Well, something else appeared to start to take its place. 2 Wednesdays ago, we had a large bullish opening long white Mariposa that closed over both the 50% Fibonacci line at 217.45 and the long moving average. However, this move was tempered for the rest of last week as prices subsided back below the 50% Fibonacci line and long moving average, but continued to harry the acute bearish Andrews pitchfork enough that I have retired it and instead started to use the more shallowly bearish shift pitchfork. Even this was not secure, as last Tuesday prices pushed up not only through the long moving average and the short medium moving average, currently at 221.5, but also the upper time, currently 222.5. It was only the congestion at 227.60, 228.40 and 229.15, plus the overhead slowly descending medium moving average, currently 229.55, that managed to contain the rise. However, as soon as the rise was contained, it stopped and reversed back down, such that I can fairly claim that the upper time may have been breached, but with only one close over it, it has not been broken. Since then, prices have basically edged lower for wary eye on the upper time, or so it seems. All these actions have posed the question as to whether the possible bearish halfway hesitation may no longer be viable, and if something else may take its place. Indeed, by only true grit, determination, a good deal of luck, we found that the big head and shoulders top pattern has so far survived this as a topping pattern. It may well still end up being a continuation pattern. We shall see, but I suspect a significant decision is not too far in the offing on this. London coffee. The key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 2021, rather than when New York had it, which was in early February 2022. This difference has been crucial to the early formation of a pattern here in the London contract, much earlier compared to the New York contract. We have a November 2021 to February 2022 head and shoulders top. Now, admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline is currently at 21.21, and the market, which has broken down through it back in March, ended up having some difficulty since then in penetrating the support area below that stretches from the 2004 level all the way down to the secondary target X in the 1935 area. Nevertheless, 2 weeks ago, prices had further attempt lower, making a new low not seen since August 2021. Yet that achievement should be taken with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it is worth noting that the primary target pattern for this head and shoulders top had been achieved some while ago, and it was a secondary target that was still left. As I've often pointed out, secondary targets are harder to achieve. What turned out to be interesting about last week was how the market started to develop intraday indecision, with contrary patterns from Tuesday last week until last Friday. This indecision seems to have worked itself out this week, as so far today we've had a small but reasonable move lower from Friday's counter to the counter bearish dark cloud cover pattern. In part, I suspect that this may be the bearish influence of the combined overhead medium moving average, currently 2099, the upper time, currently 2097, of the newly drawn mid-February to early May bearish Andrews pitchfork, and the broken late December 2021 to date downtrend, currently at 2073. It is still too early to say if this combination of patterns will work, but they are still there. Now, given what had happened in New York sugar futures, I decided last week to also draw the bearish shift pitchfork for the same move, just in case. The market is in between the middle time below, currently 2010, and the upper time above, currently 2132. The final pattern I pointed out last week was a possible late February to date bearish halfway hesitation. To be honest, this one has had so many false starts that I am treating this latest effort with another pinch of salt. However, if prices do manage to make their way down through the congestion between 2004 to 1935, which as we can see is no easy task, then a target X1 for this bearish halfway hesitation would be in the 1895 area, right off the bottom of my daily chart. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.